Hey everybody, Tom Gentile. Welcome to our Trading Essentials webinar. This is week number 3. Glad to have you guys all here. Again, thanks for being with us here today. We were doing a last couple of weeks. We started this a couple weeks ago with calls and puts. Last week we did spreads. We talked about Darknet as a strategy. We talked about money calendar as a strategy. We talked about the Flying Five. And so I want to go through all of that in a condensed version with you. You do have the recordings for week 1 and 2. And if you do not, and you need to get those recordings, then just email us at support@tomgentile.com. This session is being recorded. You can ask questions here if you are live with us. You can put them in the Q&A box, and we'll try to answer as many as we possibly can. The other thing I wanted to let you know about is the disclaimer that you see here on the screen. All right, I put this on every single webinar that we do, and you can read it in its entirety with the recording. Okay, a couple of big points I want to mention. Obviously, number one, stock and options trading has large potential rewards, but also large potential risk. And then number two, Optionetics, myself, Jay, Devin, and everyone associated with Optionetics and Tom's Trading Room, we are here as your educators. We show you how we trade. All right, we're not personal investment advisors. We do not give specific trading advice. You need a broker to trade with. You must meet certain requirements, and everything we're going to talk about today is in US dollars unless noted otherwise. So where are we and where can you find us? Optionetics.com. If you were to go into Optionetics.com, you will see this screen and kind of gives you an idea of those of you that are new to us, returning Optionetics students. If you used to be a platinum subscriber, all right, we have a new software tool called Tom's Option Tools. You need to check that out, and you can click on any of the buttons here to get you there, and a little bit more about myself. All right. On week 1, we talked about stock selection. We also talked about stock lists and calls. All right. Week 2, we talked about, we did a review of calls and puts, spreads, trading with Darknet and Money Calendar. And of course, today we're going to do a little bit of review with case studies. And we're going to hand it over to Devin Pearsall, who's going to talk about credit spreads and what he does called the layered credit spread. So that is our plan for today. So if I were to do a review of everything that we've done so far, I'm going to move over. We're going to actually look at our review right on the Tom's Option Tools site. So what I did first was I wanted to show you the Flying Five. The Flying Five were the 5 stocks in the Dow Jones Industrial Average of the 10 dogs of the Dow that were the cheapest. We did this on week 1. And what I showed you was on week 1 and on week 2, we talked about spreads, but we put these into a folder. And you can kind of see where they are. Here's the Cisco 37 call. All right. That gives us the ability to buy Cisco at $37. These are leap options, so they don't expire until January 2019. All right. Probably the longest term trade you're ever going to see out of me. But you see here we've got a series of calls. Here's a Cisco. This is a call spread, buying the 40 and selling the 45 call. And this is with 1 year to expiration. And you can see, I'll show you a little bit more as we're moving on, but General Electric was on here. This is the only one of the bunch that's actually losing money right now. And in fact, if I were to update this again, I think this actually came a little closer to where we are today, because GE in the last couple of days has had a sizable move back in the direction of going north. We also have Coca-Cola on here, the Coke January 2019 45 call. We also have a Coca-Cola 45.50 call spread. Right, Pfizer 35 call, Pfizer 35.40 call spread, and Verizon the 50 call and the 55.60 call spread. The difference between a call and a call spread is that call spreads you want to look at doing for lower in price. Okay, they're not going to move around as much. What you've done is you've really shaved off a lot of the price and a lot of the risk and a lot of the movement that happens. And so it's more of a trade that you want to see mature in value. As you can see here, these were all open based on trades that we'd put on in the first week. And you can see here how they've done so far. This is the highest, the best that they've done. This is obviously the lowest that they've done. And this is the last profit and loss price. So you can see here, Cisco's actually up a good bit. You've got GE down. Coke is up, Pfizer's up, Verizon's up. And then down here we have a portfolio performance. So this shows all the trades that we put on. And you can do this in Tom's Option Tools with any trades that you have. And what it'll do is it'll run a portfolio performance showing you how many of the trades are currently up, how many of the percentage of trades up, percentage of trades down, and a lot of other information in here that you can utilize if you like looking at numbers. All right, but all of that is available right there on tomsoptiontools.com. This shows you from January 3rd and where this has gone, and as of today, and how that portfolio has grown in value. Now, this is based on one contract or one spread. I didn't base this on a dollar amount or a percentage of portfolio amount. I just simply did it as the minimum contracts traded. So that's pretty cool that that this is already up around $470 as we move forward. Okay, but again, call options simply you're bullish, you buy a call. If you're bearish, we look at buying puts. Spreads we talked about where you're buying the lower and selling the higher. I'm going to show you the spread that we were discussing last week, which was Priceline.com. And we looked at Priceline.com and we looked at the buying the lower strike, selling the higher strike, and really trying to hedge off what something like this would cost. And you can see here that buying these calls, you're talking about almost $28. That's $2,800 for one call. All right. But you can hedge that by selling something a little bit higher. And what that does is that brings money in to help you pay for the spread or the call that you bought. All right. I showed this as a 2 and 2. And the reason I showed it as a 2 and 2 is that way you could see a way of being able to get out of half of something if it doubles in value, which is one of our rules. All right. So you need to have at least 2 of something if you want to sell half of it. Notice that this trade last week costed $325. For 2 of them, that's $650. Right now, they're currently up a little more than, 21.5% as of today's numbers, even with all the jerkiness that's gone on with Priceline.com. If you can see, it was trading near 1950 last week. It came down to almost 1900, went up today above 1980, and is currently sitting around the 1955 area, so a little bit higher than where we are today. But you can see the profits have come in; they're coming in really nicely. And then this is a trade again that we're looking to mature in value. All right, these are using the February 16 calls, so you're looking at sometime in the next 3 weeks before this comes off. Now there are 3 things that can happen to a spread. All right, it can all expire out of the money. And that means that you would lose no more than the $325 per spread, no matter how low this could go. It could also expire in the money, which means that you would stand to make the most of this. If this went above, for instance, if Priceline were trading above 2,000 on February 16th, you would now have the 1990 calls that would be exercised. And that means you'd have long stock at 1990. The 2000 calls would get assigned to you, so that'd be short stock at 2000. You know what you have when you're long stock at 1990 and you're short stock at 2000? A 10-point profit minus what you paid, which means you end up with that maximum profit return. Now, the only other area this could be is somewhere in between. And if it's somewhere in between 1990 and 2000, the best idea I can come up with is simply selling this and getting out of it before you get to expiration. All right, because the last thing you want to do is have your 2000 calls expire worthless and you get assigned stock on the 1990 calls. All right, so this is one you want to pay attention to as you get closer and closer to expiration. But those are the 3 scenarios that can happen. All right, below 1990, above 2000, or somewhere in the middle. And you need to have a plan for each. And those are the 3 different scenarios that we lay out. All right, so love to follow this one along and keep an eye on this one, and we'll see where it ends up going. The great thing about this is that this trade is expired before the earnings, and Priceline stock typically runs up prior to earnings. Now, something else we talked about was Darknet last week, and Darknet was our channel collision signals, and I just want to show you where those are going so far. So got a couple of charts I'm going to show you. This was IYR. And last week, we had a buy signal come out on IYR, and you can see where that's gone at 77.5. Now it's up to around 79, so that's cruising along really well. all right, because we had a channel collision that happened, and we were looking for this to come back up and get to around the $80 area, and it's well on its way, all right, so that's IYR. Next thing we looked at on Darknet was Hershey. If you remember, we were looking at Hershey. Hershey had a rebuy last week, and that was right around the 108.5 area. And right now, Hershey's trading around 110.26. So it's even up nearly 2 points just in the last week off the rebuy. Okay. And this is the Hershey trade I wanted to show you that we were looking at. Remember, this trade was the February 9th, 2018, 106 calls. They were trading just under $4. Right now, they're going for 460 by 510. So they're up around 23% on the day. Right? We went to Money Calendar. If you remember, Money Calendar we were looking at is our calendar that helps us spot high probability opportunities looking at 10 years of historical data. Last week, we were looking at, we looked at a number of stocks, but one that we looked at was LNG. And now when I say a number of stocks, they're all doing very well. But I wanted to talk about the ones that we brought up on the screen and we actually showed option prices. LNG Cheniere Energy. Right, was trading for $2.21 or $221 for the Feb 55 calls. Right, those are now bid 360 by offered at 375, and you can see what's happened in the last week where we've got this pop up. Right, we got this pop up. It's making new highs for the year, and of course this one's up about 66% just in the last week. Again, this was based off the Money Calendar system that we use. Another one we talked about right after LNG was IWM. This is the Russell 2000 ETF. All right, IWM, we were looking at a spread. This was the 159-162 call spread. And this 159-162 call spread was trading for around $111 per spread. So if you bought 2 and sold 2 at these prices, you'd be paying $222. Right now, this trade together, the 159 calls are up $280. The 162 calls are down $178. So when you take what you got, what you made versus what you lost, that is a $51 per contract spread increase, or $102 if you did 2 and 2. Still, it equals 45.9% return based on the trade. As you can see, continually moving up. Not so much of a move up today, but you can see what's happened in the last week since we looked at this trade last week. All right. All of this I did last week. Every one of these trades I saved and I put them into a folder, and I was easily able to bring these up and take a look at them, guys. So that is my quick down and dirty review of calls, review of puts, spreads, Darknet, and Money Calendar. So let me take a look and see if there are any questions before we get into our conversation for today, which is credit spreads. So, Jay, do you see anything out there that I need to take a look at?
Not from a content standpoint of what you've done the first 2 weeks or what's to come.
Yeah, and guys,
there's a question about the SPX action today if you wanted to address that or get to that later.
Yeah, well, I mean, this is nothing surprising to us. In fact, we talked about at the beginning of the week, we were discussing with our live group, a group that trades with us live every week. We talked about IBM. We talked about Priceline.com. We talked about XLY. And, there's a lot of these type of trades that have now doubled, their options have doubled in value. And our rule, you take half of it off when it doubles in value. So, we were sitting in good positions we were sitting in very good positions coming into today to take half that trade off, to take half of these particular trades off, the shorter term stuff. The longer term stuff takes a little bit more time for that to end up happening. And so, when you look at something like why did the SPX turn around so dramatically today? Again, there was a big open this morning based off of a lot of move overnight. And so I think a lot of traders were just basically taking short-term profits. I don't think this is over by any means at all, but we are seeing the big jump, big jump in terms of what's happened with the markets. And I think the volatility is going to be sticking around, though. All right, so let's go ahead and let's move on to our guest trader of the day. and that is Mr. Devin Pearsall. So, Devin, good morning.
Yes, sir. Hey, good morning, Tom, Jay, everyone else. Excited to be here, and boy, it looks like you guys have covered a lot of information over the last couple of weeks.
Yeah, and I want guys,
So,
I'm for the guys that just joined us because there's a couple of people that missed week 1 and 2, and I
oh
apologize
yeah,
for cramming it all in the first 15 minutes, but you can get all of what I talked about in detail off of our last two webinars, and I'll tell you, here's a good place to go get that, and then I'm going to turn this over to you, Dev. So I'm going to put this in the chat box. So it's www.tomgentile.com. Oh nope, let's try this again www.youtube, because we put our stuff on YouTube as well, tube.com/Tom's Trading Room. All right, I just posted that to the chat box so everybody can take a look at that and get that in your own time. Just go ahead and grab that and save that because you'll want to go back. And if you subscribe to our YouTube channel, you'll get all of our videos that we put out. You'll get notified every time we put a new video out, which is almost once a week. We're putting new videos out there on various subjects. So, Dev, are you ready to take control of this thing?
Yeah, I think so, Tom. Let's switch over now. I did manage to get my backup computer online, so you get to roll the dice and
all right.
Hey, you got it.
I rolled.
We got the right computer here online. So let me just do this, and let me just test. All right, looks like we are good to go. So, all right. Well, hey, welcome everyone. Tom kind of wrapped up on in regards to talking about debit spreads, or buying spreads. And in today's conversation, we're going to shift gears a little bit and talk about selling spreads. And some of you might have the question, okay, well, which one is better? And the answer is both. They are both fantastic tools. They are both tools that you could trade at the same time if you wanted to. And they're both tools that, really can accelerate, limit risk if they are traded properly. And this is one of my favorite topics to talk about in regards to stocks and options. So let's just roll right into this and get started. Tom already put the disclaimer up. We are going to be looking at some case studies here today as well. Although today is kind of a unique period. It's actually kind of in between when I like to trade. Next week is going to be absolutely perfect. 43, 44 days before options expiration for March. We'll get there here in just a few minutes, folks. But please keep in mind as we look at case studies, these are not recommendations to buy, sell, short, or cover. Tom's already discussed that. So here's what we're going to get into today. And we have a lot of information, and quite honestly, one of the most challenging things for me was to figure out, okay, how do I, what do I talk about in the hour or so that I have here with you all? Because I could talk about this subject for days, really. But I want to start with talking about the markets, just for a couple minutes. The markets have been absolutely crazy. If you've been long the market, you've been very happy. If you have your 401ks, your pension accounts, retirement accounts, buy and hold, you are very, very happy. Is that going to continue? We'll get there in a minute. Credit spread basics. We're going to move into layering. What layering is? This is a technique that I came up with about it's been about 12 years ago now. This is nothing that I came up with last week. 12 years ago. This system I'm going to teach you here, or at least introduce you to today, is 12 years in the making. It's been time tested. It works in low volatility markets like we're in today, in terms of low volatility with options, high volatility markets like we had been in back in 2008. We're going to get into the two keys of layering, do a quick overview of money management, and that is really the key. It's super easy for me to teach you how to find a 92% probability trade. We're going to start this process today. In fact, I'm going to show you. I'm going to walk you through what's involved with actually finding a live 92% case study here within the hour. And then I know many of you are already registered for the online series, the online workshop that I am starting up next week. I do this once a year, so I want to just spend a couple minutes and talk about what to expect for those of you that are registered for that. So let's switch over to the markets here just for a couple of minutes. And if, let me go over here and we'll switch over here. Basic chart of the Dow, right? Now this shows as of yesterday's close, and you can see the arrow where that is. Yesterday, the Dow closed at 26,210. Unbelievable, pretty much unchanged on the day yesterday. Today, we gapped up a little bit, as Tom said, and currently the markets are up. It looks like 46 points, kind of selling off a little bit here as well. Above the 50-day moving average, above the 200-day moving average. It seems like the lows continue to get higher, the highs get higher. The markets have a little bit of pullback, and it seems like that seems to be an opportunity to buy and go long, right? At least that's what the past has proven. So, million-dollar question, is this trend going to continue moving forward? The number one question that I get right now when I'm talking to folks about trading or investing is, Devin, where do you see the markets in the next 6 to 12 months? Okay, I'm going to tell you. Okay, I'm going to be very honest with you. Okay, I have absolutely no idea what the markets are going to do over the course of the next 6 or 12 months. Not a clue. Right now, before everyone logs off and says, okay, why do I want to listen to this guy over the course of the next hour when he has no idea what the markets are going to do? You know, I'm just being honest with you. You know, sometimes we have an idea of what the markets are going to do, or, you know, where we really have a hunch or we're feeling, or we look at indicators and technical patterns. You know, right now, I'm not sure. You know, I do kind of have a little bit of a hunch what I think the markets are going to do, but we're going to kind of tie back into this later in the hour, where with credit spreads, now I want you all to listen very carefully right now, with credit spreads, we don't necessarily need to know what the markets are going to do, where the markets are going to go. We can be wrong on market direction, in some cases by 10, 15, or even 20%. Okay, let me say that again. We can be wrong on market direction, in some cases 10, 15, up to 20%, and still make a decent return on investment. So I want to tie this picture because, quite honestly, you know, if you, I mean, hey, watch CNBC for 10 minutes this afternoon. One person for 5 minutes is going to tell you the markets are going up, right? One guru. The next guru is going to tell you for 5 minutes the market's going down. Two different opinions. So imagine a world where we can essentially mute both of those individuals, right, and say, who cares what the markets are going to do? Let's position high probability, 92% plus probability trades, and simply make adjustments as the markets move directionally or when we are wrong, okay, and not have to predict market direction. So that's the tool. That's the mindset that I'm introducing you to here this morning. So let's switch back over to our slides and jump right into spreads. Okay, so you all with Tom, you ended up finishing up on debit spreads. So credit spreads are essentially just the opposite. And there's two different types of spreads. We have bull put spreads and we have bear call spreads. Now let me do this. I like to use my my pencil here quite a bit on my screen. Let's see if this works. All right, perfect, it does. All right, so bull put spreads are said to be bullish, or we want the markets to go up. That is partially true. Actually, bull put spreads are semi-bullish. We want the markets to stay above a certain price. Bear call spreads, okay, or bearish, we want the markets to go down. In the industry, bear call spreads are said to be bearish. Again, that is partially true. With a bear call spread, we want the markets to stay below a certain price. Now, let me do this. Let's switch over, take a look at a basic chart, and let me show you how we would position these types of spreads. So, for example, this particular stock or index market, it doesn't matter what it is at this point, is trading at a range approximately 590-ish. So for our bull put spreads, we would position those below the current price. Okay, anywhere where that green is. Okay, green, bullish, we want the markets to stay above a certain price range. So for example, what we would do, and let me switch my pen color here so you all can actually see this. Perhaps we would go do something like this, maybe down at the strike price of 520. Okay, what we might do is sell a put, and then we would turn right around and we would buy a put option. Again, just the opposite of a debit spread. So by doing this, we are going to create a credit. Now we'll talk about this. I'll switch over to the tablet computer. I'll give an example, where we'll scratch out some actual numbers on the sell put and the buy put and the credit and that sort of thing. But right now, what I want you to see is if we create this spread down here at the strike price of, let's say, $520, we want this market that's trading near 590 to stay above, right, this range of 520. So with this example, if this stock or this index market stays above $520 between now and options expiration, then we would make a certain return on investment. Maybe that return on investment is 2%. Maybe it's 5%. Maybe it's 10%. Maybe it's 20%. It could be a variation of whatever I just mentioned there or higher, depending on the amount of risk that we want to take. So for example, we could position the spread higher in the chart, which would give us a higher return on investment. It would also give us a lower probability. We could position the spread lower on the chart, which is going to give us a higher probability and a lower return on investment, because essentially we can be wrong by a larger amount and still make a small amount of profit. So the opposite of the bull put spread is the bear call spread. And what we would do in this example here, let's just take the strike price, near 640, is we would sell a call option, and then directly above it, we would buy a call option. That would create that particular bear call spread. Now, in this example here, we would want the market to stay below a certain price. In this example, we want it to stay below $640. Now, between these two spreads, which one is better? Devin, should I be trading bear call spreads or should I be trading bull put spreads? My answer to that might surprise some of you, but it is yes, right? Both, all of the above. But Devin, the markets are going up. Why would we want to position a bear call spread when the markets continue to crack new highs? Now let's be careful about that. Are the markets really going up? And the answer is, well, the technical answer is no. The markets have gone up and they've done very well. And they may or may not continue to trade higher, right? Let me ask you this. How often have you predicted market direction on a stock or on a market like the Dow or the S&P or the Russell or IBM or Boeing or Caterpillar or, pick a stock? How often have you predicted the markets are going to move a certain direction and been wrong? Okay, see, my point exactly is, so we want to be careful with credit spreads about predicting market direction, because oftentimes we are wrong and we don't want to have that sort of influence on our spreads. Instead, what we're going to do is this. What if we position both of these? Now, this is called an iron condor if we position both this bull put spread and this bear call spread on the same stock at the same time. Now what we want is we want this stock to stay between this ginormous trading range, and it can fluctuate in here. And if it fluctuates within this ginormous trading range, then we can make a certain amount of money, right? We'll talk about what that is here in a few minutes. If we're wrong and the markets go up, then we, in this example, we would lose. We would lose on half of the position, right, or half of the iron condor, because our bear call spread would lose money, our bull put spread would make money. Okay, let's go. Let's jump forward here and switch over to the tablet computer and look at some actual numbers. So let's just say we have a stock that is trading at $47 per share. So what we might do in this example to create an iron condor or to create a credit spread is we would start off, let's just start on the put side here. We would sell a $45 put option. Let's say that put option gives us a total of a $4 credit, right? As of right now, that's called a naked put. It can be very risky. We're going to reduce that risk by creating a spread, and we are going to buy a $40 put option at a total cost of $3. So we receive 4, we pay 3, which gives us a credit of $1. Now, if this was, for example, on 10 contracts, right? Many of you know 10 contracts is going to equal 1,000 shares. 1,000 times $1 is a $1,000 profit, providing that this stock at 47 stays above this price at 45 between now and options expiration. Okay, now, whatever, and that could be February's expiration. It could be this Friday's weekly expiration. It could be March's expiration. So we have not talked about the time frames and where we should be looking to position these types of spreads. Now, on the bear call spread, let's just say, for example, we create a spread up here at, let's just use strike price of 50. We would sell a $50 call. Let's just use the same numbers. We'd sell it, for example, at $4, and then we would buy a $55 call for a total cost or debit in this example of 3, which is going to give us a credit of $1. Now, just because we have a credit of $1 does not mean that this credit's going to magically show up in our trading account the next day. I want you to think as a credit spread, when we create this credit of 10 contracts at $1 or $1,000, in this case, right, times 2, because we have a bear call spread and a bull put spread. I want you to think of this as a maximum profits. Okay, this is the most amount of money that we can make on a particular trade. Now, some of you might say, okay, that's great, right? We can make $1,000. We can be wrong by a fair amount, depending on the market that we're looking at. But what if we're wrong by a lot? What if the market goes down here to $39 per share? If that happens, Devin, you should tell people that they can lose their back end, right? That they can lose more money than they're fixing to make. So, which by the way is true. Okay, now let me talk about that and tell you why I like this. Okay, which may seem a little odd for somebody to say right now, but on a credit spread, for example, if we're fixing to make $1, our maximum loss, okay, this is our maximum profits $1, our maximum loss is going to be the difference in strike prices minus what our profit is. So if we take the difference in strike prices, which is $5, and we subtract the $1 credit, we have a max loss of $4. So if we're wrong, we're going to lose 4. Okay. Now, this has what's called an inverted reward to risk ratio, because with credit spreads, you are willing to lose more than you're going to make. Now, why on God's green earth would anybody be willing to lose more than they're willing to make? And the answer is kind of simple. It is probability, because the probability on these trades is substantially higher. Now, even though we have a 90, 92%, 94% probability on most of these trades that we're going to be looking at here today, okay? Losing $4 or taking the maximum amount of loss is still unacceptable. So I want you to think of this as well at this point as trading a stock, okay? Technically, we could lose $4 on this particular trade. Okay, think of it like buying a $50 stock, right? If we, let me just grab a new sheet of paper here real quick. If we look at or let's just take the same stock at $47, and forget the spread right now, forget any options. Let's just go buy this particular stock at $47 per share, right? So we go out there and do that. What is our maximum loss on a $47 stock? Okay, our maximum loss technically is $47. Now, some of you might say, well, Devin, come on, we're not going to actually lose $47 on this stock, because if it starts to go in this massive downtrend and break major levels of support, right, we're going to do what Tom and Jay and other instructors have taught us, and we're going to use some sort of a stop loss, or we're going to use some sort of an option in lieu of a stop loss to significantly reduce this $47 loss down to something that's more manageable, right? So let's take that same, which is true, by the way. So let's take that same mindset. Let me ask you this. Do you think there might be a way to take this $4 maximum loss and significantly reduce it while maintaining the integrity of a 92% probability on this type of a trade? Okay. Now, I hope I have everyone's attention right now, because we're going to talk about that. That's the tricky part about this. It's easy to generate this $1,000 profit, okay, or maximum profit on a credit spread. That's easy, super easy. It's how do we reduce that maximum loss to something that's more manageable, okay? And the answer is two parts. Number one is called delta adjustments, and number two is called debit spread insurance. Now that sounds intriguing, and it is. Okay, so let's go back over to the tablet computer here, and let's take a look at credit spreads as a bar. Now, this is how I like to visualize spreads, or teach them, I should say, to somebody who does not have a lot of experience trading credit spreads, or even somebody that does have experience trading credit spreads that has not been successful with them. So let's say that we have this same stock at a price of $47 per share, okay? And let's create that same spread, but let's draw it out as a bar at a price of $45. Now, so we create a 40-45 spread, and let's just say that this is based upon February's expiration, which is next month is on the 16th. And let's just say that that trade had a 25% return on investment, which it did, right? If we're risking 4, receiving 1, we have a 25% return on investment. And let's just throw out a random number, okay? I'm just making up numbers at this point here. Let's say that it has a 70% probability of staying above $45 between now and February 16th, okay? Well, first question, Devin, how do you measure probability? And that's a little bit more complicated to answer at this point, but probability is actually, it's very easy to measure, and it changes dynamically, but we can use the options delta to come up with a simple calculation to measure probability, or some fancy software tools like what Tom has on his tools can measure probability, and it does it for you at the click of a button. So let's just say it has a 70% probability. Now, what we could do is say, well, let's change this. Let's change this spread down to a lower level, okay? Let's get rid of the top part of this bar and keep the February 16th date. Let's move the spread down to a price of $40, right? What would that look like? Well, let's say if we move the spread down to $40, let's just say that it has an 8% return on investment, and let's say it has a 90%, again, just making this up right now, probability. There's no correlation between ROI and probability in terms of mathematical, so anyway, let's say that we move the spread down here to the short strike down to a level of $40. Our return on investment does what? It drops. What happens with our probability? It increases. So which one's better? Now, this is the trick to finding good trades, is how do we position these spreads so we're not going to have to make an adjustment down the road? How do we position these spreads so we're not going to have to cash in with an insurance policy down the road, right? That's the $1 million question right here. So To help answer this question, let's do this. Let's take a look at some data on a real chart. Now, what we're going to look at is, first off, we're going to take a look at data on the Russell. Okay, ticker symbol's RUT. Now, let's talk about that one first. Why the Russell? Why am I showing you an example of the Russell? Okay, why is my first example on the Russell? Why is I'm looking at forward here on my slides, why is my second example going to be on the Russell here today? And why is the trade we're going to go out with you and I together in probably less than 10 minutes and find, why is that also going to be on the Russell? And the answer is, well, that's because that's what I like to trade, is the Russell. Okay, we're going to learn how to layer the RUT, R-U-T. Now, why the Russell? The Russell offers the highest probability trades compared to other markets. So it offers the highest probability trades that pay the most amount of money. Now, that is a little complicated at this point for me to share with you all exactly how to measure that. It was probably, maybe 8-9 years ago, somewhere in there, kind of playing around, and I came up with a great way using the average trading range to measure and compare apples to apples. For example, what market is best? And I started thinking about this in regards to numbers, in regards to math. Okay, and I'm not very good at math. In fact, I was in the half of the math class that made the top half possible. But I understand that when we have higher probabilities, we can make more money. And I started thinking about, okay, why am I here as a trader? Why am I here as an investor? And the answer to that is quite simple. I'm here as a trader investor because I want to make money. I want to make the most amount of money in the shortest period of time, taking the least amount of risk. And I think that's why you're here as well. I mean, it should be, right? I mean, you're not here to learn how to lose money. You're not here to learn how to make money at the slowest rate possible. I think that you're truly here because you want to make the most amount of money in the shortest period of time, taking the least amount of risk. Isn't that true? So if that's true, then let's take a look at, okay, where do we put our money where we have the highest probability of accomplishing that? You see, most traders don't think about that. And you know what? That's one of the beauty of Tom's trading tools, is that he's got all these filters with going through the Darknet system, for example, looking at the calendar trading system, looking at historically which stocks have done well or not so well on historical trading days. You know, what's Tom doing with those filters? He's increasing the probability of being successful. He's looking at how do you make the most amount of money in the shortest period of time, taking the least amount of risk, right? That's why we do this. So with credit spreads, you know, I'm very, very adamant about trading the Russell. That's where the money's at. That might change down the road. But for those of you that are signed up for my program that I'm starting up next week, is right around session number 2. I'm going to walk you step by step through the process of showing you why the Russell is the best market to trade credit spreads and layer credit spreads on right now. Now, I'm going to do that for 2 reasons. Number 1, so you don't just take my word for it, you can actually see it. But more importantly, at some point down the road, the markets may change. I used to trade the OEX quite a bit back in the old days. Maybe a similar market will pop up. Maybe the S&P, SPX, will become a more favorable market. And should the Russell fall out of favor, I want you to have the tools and the education necessary to make a couple of calculations and determine which market is the best market to trade to give us the highest probability of making the most amount of money, taking the least amount of risk. So let's start by taking a look at some examples here. This is on the Russell. This particular market is trading near a price of like 590. Now, some of you might say, well, wait a minute, Devin, the Russell's like at 1,550 right now. This chart is old. And you're right. This chart, as a matter of fact, is, I don't even know how old it is, 7-8 years old. The next one I'm going to show you is approximately 3 years old. And then the third one I'm going to show you is going to be current. Now, the reason I want to show you all these different time frames is to show you that the characteristics in different volatility markets is exactly the same. This is one of the reasons that I love the Russell. So I don't want to just show you examples from last week or examples from last year. We're going to be looking at really a 10-year span over 3 different examples. And you'll notice that the characteristics are virtually the exact same in terms of probability and profit. So when we're looking at a market to build a relationship on, these are things that we're looking at. Can we build a relationship with the Russell and have something that we have a high degree of certainty that we can continue to trade 3, 4, 5 years down the road? Okay, so let's take a look at a spread. This is just going to be a bull put spread. We're not looking at the bear calls. We'll look at the bear call in the next example. So this is using the strike prices of 530, 540. So a trader has sold the $540 put option, has bought the $530 put option to create a spread. This spread generated a 21% return on investment. This spread had a 78% probability of staying above this particular price, so 540. So think about this. We could make, and these are real numbers, by the way. These are not made up numbers. We could make a 21% return on investment, or could have, I should say. The Russell can fluctuate between 590, go down here to 540, back up, or anywhere in between. We could be wrong by $50 a share. We could be wrong by 50 points and still make a 21% return on our investment. Okay, starting to see why I like credit spreads. Now, this is not a good trade, by the way. Okay, but I mean, some of you say, hey, this looks pretty good. We can be wrong by a lot and still do quite well. Yes. Okay, but this is not what I'm looking for. Let's take a look at another example. Okay, same chart, same day, but we're using different strike prices. Now, let's take a look at the strike price down here at 510, and 500 is not quite drawn to scale, but that's all right. So we could be wrong now by 80 points. The difference between 510 and 590 still generate a 11% return on investment. Now what happens? What's happening here? The return on investment is dropping. Our probability is increasing. Okay? Probability is increasing because the amount of money that we can be wrong by is increasing. Okay, that's very good. Now, great trade. This trade does not give me goosebumps quite yet. Okay, and that's what I'm looking for, by the way. You might want to write that down. We're going to look for the goosebump trades. The trades that seem so good that you're thinking to yourself, why wouldn't somebody take this trade? It seems too good to be true. That's what I look for, the goosebump type of trades. And here it is right here. Down here at a strike price of 470, 480. Okay, look at this. A trader can be wrong by 110 points and still make a 5% return on investment, and that gives us a 93% probability on this particular trade. Okay, now think about that. Let me grab my calculator. What did I do? There it is. I was just using it this morning to assess some risk on some other stuff. So if we take 110 points and divide that by 590, that is like 18, almost 19%. So we can have this market go down 18+%, and a trader can still make a 5% return on investment in 45 days. Now, I call this the flux factor, okay? The flux factor. We can have a flux factor of 18% and still make a 5% return on investment over 45 days. Let's take a look at a different example on the Russell, a little more current. Again, I said we're going to kind of work our way up to current trades, right? That other trade was 8, 9, 10 years ago, somewhere in there. This one's 3. Now, this one incorporates both a bull put spread and a bear call spread. These are real numbers. They are not made up. In fact, you can go back and reconstruct these trades on Tom's tools and see them for yourself. 31 days to options expiration, okay, not the 45. Now, in terms of time frame, and we'll talk about this in just a few minutes as well, is with time frame, I like to look at my spreads between and layer. We haven't talked about layering yet, but between 20 and 45 days before options expiration. Okay, there's a reason for that. I'll touch on it just a little bit. Right now, let's take a look at this. Here's a bull put spread. So we're selling at the strike price at 1030, buying 1020. Okay, way down there. Creates a 5.8% return on investment and a 92% probability on this bull put spread. On the bear call spread, we are selling up here at 1270, okay, buying at 1280, creating a 5.4% return on investment and a 94% probability. Okay, now not too bad. Let's take a look at this. In other words, right, we can make a combined like 11, 12 plus percent as long as the markets stay between this ginormous trading range. So if we take 1270 minus 1030, what is that, 240 points? Let me write that over here. So the markets can fluctuate. We can have a flux factor of 240 points. The markets can fluctuate. That's like 20%, right? 240 divided by roughly the current price on the Russell. The markets can fluctuate roughly 20% up and down. Put FF next to it, flux factor. Well, let's put FFB, flux factor baby. That one deserves that. So the markets can fluctuate 20% up and down, and a trader can still make a 10, 11, 12, 13% return on investment in 31 days to options expiration. Now, that's what I call a goosebump trade right there, okay? And now if we start mixing up some technical analysis, right, we're below support, we're above resistance, we're in that safe zone right there. Why wouldn't somebody do this? Now, I want to go back and answer, or talk about, I should say, remember when we were talking about market direction? Okay, kind of a side top, or kind of switching topics here just a little bit. We'll come back to the Russell. Remember that I don't know when it was, 30 minutes ago or so, we were talking about the Dow, where we are at. Currently, we're down a little bit right now. It looks like we're, take that back, we're up 7 points. No, I'm sorry, it's down 7 points at 26,204. And I made a comment. I said, folks, to be honest with you, I have no idea where I believe the markets are going to go over the course of the next 6 or 12 months. I don't have a flipping clue. Now, we go back over and we look at a chart of the Russell. Do we have to have a flipping clue of where the markets are going to go when we could be wrong and have a trade fluctuate, or a system that can fluctuate, in this example, 20%? And still make a 10, 11, 12, 13% return on our investment in approximately a month's period of time. This is why I love trading credit spreads, is I can be wrong by a substantial amount and still do okay. You know, I mean, that's over 100% a year if we could do this trade in and trade out, isn't it? I mean, that's not too bad. Even compared to last year's numbers when the Dow, you know, was up 22%. Now, and I'm not saying we can do this on every single trade, because occasionally we are going to be wrong, and we're going to be in need of making an adjustment. Okay, but this is why I love this particular system. And imagine waking up someday and seeing the Dow down 300 points, or 500 points, or 600 points, and 700 points, somewhere in there. With your directionally based trading systems, you're like, oh, shoot, oh, man, what do I do? Am I getting stopped out? Oh, I forgot to put those stop losses in place. I need to panic. With this system, I say, well, sure, I'll go have a nice cup of coffee with you down at the local Starbucks and chit-chat about life and family, and because this doesn't need my immediate attention. And that's the difference. Now, I'm not saying that directionally based trading is bad. Okay, I'm not saying that at all. In terms of full disclosure, I trade directionally. This last year, I've traded directionally a lot. Okay, just like a lot of other people. But as markets change, percentages of my portfolios change as well. And with this system, I don't have to worry about what the markets are going to do. Now, let's go ahead and jump forward here. Let's take a look at a more current spread. And I want to show you this because there's a couple ways to find high probability credit spreads. And the first way is you log into your broker, you type in the Russell, which I've already done here. We can see where we're at, up here currently, and we can go through these strike prices on the calls and the puts, and we can look at, okay, where is our high probability trades? There's a lot of combinations here. Or what we can do is we can be a little bit more modernized in terms of finding our trades. We can use a tool. Okay, we can ask a tool to go out there and find some information for us, and we can go, for example, I'm going to go over to the home page on Tom's option tools. I'm going to go down here to premium tools. Some of you have this right now. We're going to go over to Credit Trapper. Okay, now I'm going to left click on that. Credit Trapper is a part of Tom's tools that I helped build. And years ago when Tom asked me to start teaching these classes for him, I said, hey, love to do it. Can only a couple things here. Number one, Tom, I can only do this once a year. I've got too many other things going on right now. Number two, it'd be really cool to be able to push a button and do a lot of this stuff. And so I worked with his developer, and this was an ongoing process for a long time, working with his web developer to get this thing done. It's very, very simple. And all we do is we push search, and it will automatically find us the high probability trades on that particular day. Now, before I show them to you, I do want to note that I'm using data from a couple of weeks ago. Now, the reason I'm using this data instead of data from right now today is because, see, right now we're roughly 22, 21 days before February's expiration. We're 50 days before March's expiration. We're in that time frame where I don't like to open up new spreads. I like to be, you guys remember what the time frame is? I like to be between 20 and 45 days before options expiration. Now, roughly on the 4th of January, this was 43, 44, somewhere in there, days to options expiration. That would be when we start to layer. Now, I will tell you this, okay? The reason that I'm talking about credit spreads today and not next Wednesday is, or at least the introduction is next Wednesday is when I'm starting up for those of you that are registered for my online workshop. Next Wednesday is like 43, 44 days before options expiration. Next Wednesday is the absolute perfect textbook time to start opening up layered credit spreads. If we reverse the time to January 4th, that was the last most recent date, right, where that would have been the perfect time. So anyway, for on January 4th, we click on search, and it gives us 3 different trading possibilities. So out of literally thousands of combinations, we're down to 3. And that's what I'm looking for. I'm looking for the absolute best of the best of the best of the best case studies that's what I want. I want the goosebump trades. There's only 3 of them. Now, there are other trades that meet the 92% requirement, but I'm also looking for spreads that have a minimum of a 50 cent or roughly 5% return on investment. So we can see right here that we have a current spread at 1640 on the call side. There's 2 put spread opportunities here. We're roughly the credits, the cost on those is approximately the same. Choose the one that we have a higher probability of getting filled on, the one that's going to be just at a slightly higher credit. If we were to draw that out, it would look something like this. Let me grab my tablet computer here. So on the 4th, the Russell was trading at 1,555. So we could create a 1,420, 1,410 put spread that would have a 47-cent return on investment. That's pretty close to 5. I'd show you how to get filled at 50 cents. Most likely get filled at 50 cents, I should say. The other side of this, would be 1,640 on the call side, 1,650 to create that bear call spread or put these together to create that iron condor. This one had a credit of 53 cents. So there again, about a 5% return on investment. If we look at the difference here, that gives us a 220 points, okay, flux factor. And if we do the percentage, that is a 14% flux factor that the markets can gyrate up and down here, and we could still make a total of roughly a 10% return on investment on these two case studies. So that's the most current one. And I will say too, as a side note, in fact, those of you that are going to be joining me next week, we very well might be talking about this 1640. It on January the 12th, I'm looking at my trading notes here, did call for an adjustment. But this is a cool one where the loss on it was very minimal, and I wish I had a few extra hours here today to talk to you about that exact case study, because it's a really, really cool case study that, in terms of full disclosure, ended up getting closed. Because if we look at the Russell, right now it's trading at near 1,600, and we closed these well before panic time. Essentially, we're going to open up these trades at a 92% probability. We're going to start closing them when they dip below an 80% probability. We're not going to take chances on these particular trades. We're going to open them high. We're going to close them when they're still relatively high. And the reason we're going to do that is because we can roll our capital into another high probability opportunity where we have a higher probability of making more money in a shorter period of time. Kind of follow that same mindset of why we are here. So that's the current one. It's super easy to do. I do want to mention as well, for those of you that are joining me, what we're going to do starting next week is I'm going to show you how to do two things. Number one, I do want to show you how to use an option chain, how to use deltas and convert delta to probability and determine what these credit spreads are trading for by hand. Okay, I call it the old school way of finding credit spreads. There's a lot of value in that, and you appreciate the tool a whole heck of a lot more as well. We're going to be spending time going over to Tom's Tools, a lot of time clicking on the button, learning how to use the credit trapper to not only find credit spreads, but to also find and manage debit spread insurance. And this is one of the coolest things, in my opinion, on the entire Tom's Option Tools feature, is how to find insurance. This is something that my students have struggled with a little bit in the past in terms of, okay, exactly which strike prices and how many contracts based upon how many open credit spreads do we have. We can plug in a number based upon our trading style. We can click on Find Insurance, and it literally takes, I'm doing it right now, just microseconds to find exactly what we should be insuring with. It is really, this is like Geico on steroids right here. It's super cool. But again, I'm going to show you how to do this by hand and exactly which deltas to be buying insurance at, when to be buying insurance, and when to be cashing in insurance. And then we're going to learn how to push the button and do that as well. So you'll have both of those techniques, under your belt. So let's switch back over to our slides, and let's talk about the average trading or average credit spread trading system and what the problem is with it. Many years ago, I just give you a little more history on me. I decided that I was going to master credit spreads. And what I started doing was this. I would find a stock, I would look at technical analysis only, and I would start with a small amount of contracts. I would start with like 5 contracts. I got good at it, and I decided, okay, well, I'm better than 5. I want to make more money, right? So I would do essentially the same thing and repeat it, increase my contracts for a few months, go up to 10. Okay, well, I want to make more money. So I'd increase my contracts, go up to 15. That's great. I love credit spreads. I want to make more money, increase my contracts, go up to 20. Guess what happens? This is the problem with most credit spread systems. At some point, the markets will correct. At some point, you will be wrong. Not might, not maybe. Some people are, some people aren't. You will be wrong at some point. And the problem with most credit spread systems is you're always wrong with the most amount of contracts. So then what happens? You're lost. You can literally be profitable with this basic flawed system for 11 months, like I was back in the old days, and then have one bad month and give back 11 months worth of profits. Doesn't make you feel very good. It's not a good deal. So what I've done is, in my quest of trying to figure out how to work smarter and how to take less risk and still have a very high probability trade, I might say, yeah, I want to trade 20 contracts, okay? But what I'm going to do is something like this. Okay, we'll draw it in the upper right hand. You know what? We'll just draw it on the tablet computer. If I want to trade the same 20 contracts, folks, what I might do something like this. Maybe on that spread that I shared with you from January the 4th, maybe I'll trade 5 contracts at that 14, 10, 20 strike price. And then maybe I'll trade 5 contracts up here at the 1640, 1650. And as the markets fluctuate, we might add another 5 contracts of a spread. As the markets continue to fluctuate and we get closer to options expiration, we might add another 5 contracts. This is where layering begins. At some point, Devin said we will be wrong, right? So now if we're wrong, what are we going to lose on? We're going to lose on 5 instead of 20. Or what if we're really wrong? If we're really wrong, we're going to lose on 10 instead of 20. So what do we do with our losses? We're substantially reducing our losses by essentially being more diversified on the same market. Okay, this is really the start of my layering. So what is layering? Well, layering is, you may want to write this down, by the way. Layering is adding multiple credit spreads over over different time frames to bring in cash flow and, okay, key right here, and to help reduce the overall risk of our credit spreads. All right, so let's kind of break this down. So adding multiple credit spreads. Okay, let's talk about the elephant in the room. Devin, are we paying more money in trading commissions? Okay, that answer or question comes up all the time. Are we trading more or paying more money in commissions? Yes, yes we are. Back in the old days, commissions used to mean something. They used to be $30, $50, $100, $110 just to trade 10 contracts. Nowadays, for most of you, you're paying somewhere between $5 and $15. I'm going to say most of you are paying between $10 and $12 a ticket. That's about it. So yes, we're paying more money in commissions, but is paying an extra $10 or $20 or $40 or $60 a month in commissions worth reducing thousands and thousands of dollars of risk? Okay, so just want you to understand that. Some people perceive this as a bad thing. Commissions are a non-factor for me. They're essentially nothing. Okay, nothing at all. Should not be. Don't want to be tripping over pennies on our way to making and saving dollars. Okay, let's take a look at, in a perfect world, how does this work? And this can be done virtually on any index market. Does not work well on individual stocks. Okay, now it does not work on individual stocks very well because of earnings. Primarily, earnings can really mess a credit spread up. And to be honest with you, I cannot remember the last time I traded a credit spread on an individual stock. I don't remember. It's been a couple of years at least. And the index market is where I like to be. Okay. So it looks something like this. These are the average entry times. 20, 30, 45 days before options expiration. These are going to be referred to as recipes. But, in all honesty, we can open up a credit spread anytime between 20 and 45 days prior to options expiration. Anytime in that time frame is when we can open these up. So in a perfect world, it's going to look something like this. Okay, we open up our bull put spread and bear call spread roughly 45 days before options expiration. In a perfect world, markets go sideways and we open up another couple of spreads. In a perfect world, okay, markets continue to go sideways and we open up a couple more spreads, and we have essentially 3 layers on the call side and 3 layers on the put side. Okay, now as many of you know, the world is not perfect very often. In fact, in the credit spread world, it's usually perfect about 2 months out of the year. That's about it. So can this be done in today's wacko market? You know, how do we do this? And I say wacko in a good wacko way, right? In today's strong directionally based market, can this be done? So how this looks, if we're in a directionally based market, right, we open up our first layer, it's going to look something like this. As the markets continue to go up, instead of our layers tapering into each other, our layers are going to taper up. As the markets continue to go up, okay, we might do something like this. Okay, now we have 3 bull put spreads, okay, where we want the markets to stay above. We have 3 bear call spreads where we want the markets to stay below. If the markets continue to go up, then we might have to make, and this has been kind of a recent thing, where we might have to make an adjustment with one, right, maybe a couple of these spreads. Now, if we lose on 1 or 2, we close these at an 80% probability. We take a relatively small loss. Perhaps we might even have a debit spread insurance that was paid for by a credit spread anyway that might help significantly reduce a loss. We might be able to reduce, in fact, I'll give you an actual real number here if you want to, without drawing it on the board. That 1640, 1650, technically on a 10 contract basis had roughly $9,500 worth of risk. The one that I showed you from January the 4th. With the insurance, that spread got closed and lost $300 based on 10 contracts. Okay, so 5 contracts would have been a $150 loss. You guys can do the math on that. 1 contract would have been a $30 loss. So we're talking relatively small losses. In fact, we'll look at some consistency results here in just a few minutes. But so in a trending market, that's how it's going to look. And one of the problems that traders do on a regular basis is they try to wait for a market to be absolutely perfect before doing something. And in my experience, that's a mistake, because first off, by the time the markets are perfect and you get in, they're not going to be perfect for the next month. My take on it is take a few strategies, learn how to push them to the edge of the envelope, learn how to trade them in high volatility markets, low volatility markets, learn how to trade them when the markets are going sideways, trending up, trending down. And once you have the confidence to do that, then you can apply that strategy to virtually any market that's out there and do so with good results. So that's how that looks in a trending market. So, you know, we mentioned consistency. Consistency is the name of the game, okay? Consistency is what separates a good trader from a bad trader to a great trader. Whether you're trading stocks, whether you are an investor, whether you are a store owner of a chain of Subway stores, right? Consistency, repeating the same thing that works historically time in and time out, right? It's the same in the trading world. And so here's a couple of the recent classes that I've done with Tom. And I just want to go through it. I want to kind of show you some of these because what we do over the course of the 5 weeks, regardless of which one I teach, and I've taught close to 30 of these now over the years, is we track and we layer the markets for a 5-6 week period of time. And we keep track of all these case studies, and we just average them to 10 contracts because the math is real simple. In reality, I'm going to share with you how to earn the right to increase your contract size and earn the right how to trade more contracts. But based on a 10 contract position, you can see that all of these profits are about the same, right? If we're looking at 47 cents or 53 cents for a credit spread times 10 contracts, you'll see that that number right here. In this example here, there was $3,500 in profits. There was $1,000 of insurance that was spent. Now, this is a topic I've just talked about in terms of theory. I've not shared with you any actual how-tos on the insurance piece. I wish I had another 3-4 hours today to do that with you because it's really cool. which brings our profits down to 2,540. But the insurance, and some of you might say, well, Devin, that's a huge chunk out of that profit. Yeah, it kind of is. But that huge chunk of the profit reduces our risk by an enormous chunk, right? And if you want to make more money, you start by losing less. That's just what was taught to me years and years ago. The insurance is so incredibly important. Even with these numbers, this particular 5-week period earned about an 8.6% return on investment, which is not too bad for the course of 5 weeks of stress-free trading. Now, the last one that I taught, I believe it was the last class, our case studies looked a little bit different. Here they are. Okay, you get about the same profits in terms of all the spreads that we layered. Here's our total profits. Insurance was just a touch more, and there's a reason for that, where we had to add an extra insurance policy just because the rules called for doing so, which made $1,760 over 5 weeks, which was about a 3% return on investment over the course of 5 weeks. So if we were to average the 8.6 and the 3, that gives us about a 4.98% monthly average if we were to do that. So over the next 5 weeks, is that what we're going to do? The answer is I have no idea. But I will promise you that we will keep track of all of our case studies, and we'll do the exact same thing. And one of my favorite parts of the class is when we get into week number 5, and we go through and we audit all of the case studies. Because as the class starts, we start with that one layer. We will have a layer next week, and then every single week we're going to continue to build new case studies. We're going to build that picture larger, those layers greater, and by the end of the 5 weeks, it'll be very easy for you to simply pick up right where we leave off at, and it's an awesome process. One that's been very refined over, like I said, I've done, I think, 30 of these online now. So 2 keys to trading credit spreads is, number 1 is proper order placement. You might want to write down, okay, what's proper order placement? That means the goosebump trades. 92% probability, 5% return on investment, high probability trades, the best of the best of the best, the A++ types of trades. Okay, if they're not coming up on Tom scans, I'm not interested in them. I don't need to open up a trade today just to go out there and open up a trade today, right? I want to open up a trade because it meets the right requirements. That's easy to teach you. Where the tricky part lies is the solid money management. Okay, doing the delta adjustments, buying the insurance, exercising the insurance. Right? It's kind of like driving. Learning how to get the car moving forward, man, it's pretty easy. Hit the gas, the faster you push it, the faster you're going to go, right? But when somebody comes out of a blind corner and is on the verge of hitting the front quarter of your car, or you get yourself in a situation where you have to react with experience, that's where things can get a little tricky, right? So with money management, in fact, you may want to write this down right now, but with money management, there's really 2 keys. Number 1 is delta adjustments. Now, this is kind of the same way of saying, okay, we're going to look at probability adjustments. When the probability falls below 80%, you may want to write that part down, we are going to do something with the trade. Now, when I say do something with the trade, hoping is not something. We are going to take a proactive approach to closing this trade. The probability is no longer what I want it to be. We are gone, right? We want the best of the best, that's it. Insurance. And this is one of the really, really cool things. I want to just let me switch over to the tablet computer. I just want to draft out the concepts of what we're going to get into and kind of start prepping you here for next week. For example, next week we're going to look at opening up a credit spread layer that is going to look something like this. We have a bull put spread. I'll just put BPS for short. Okay, bear call spread. This is going to bring in some sort of a credit. Let's just write down 5% for right now. Okay, 5% here as well. Looks like 6, but let me make that 5 a little bit clearer. And then what we're going to do essentially with those profits or maximum profits on those trades is we're going to learn how to buy some debit spread insurance. I'm just going to kind of draft that out here in red. So we're going to take our credit spread profits or maximum profit potential, and we are going to buy these insurance policies that are in red. Now, when we first start out, by doing so, we create a cash neutral position. As the market moves and shakes and fluctuates either up and down, or who knows what it's going to do. I mean, it's one of the cool things about these classes is we don't know what the markets are going to do. We react to them together. As the markets move, we're going to learn how to layer additional spreads. Those additional spreads is what generates a majority of the profits for the trading month. And if we have a small move, then we have some insurance that we can use to help offset a credit spread loss. And it's a great concept because the insurance is paid for by credit spreads that are open, and that creates a safer environment as that 45-day window shrinks down to 20 to continue to layer additional spreads, in most cases without extra insurance. And we can generate profit knowing that if we have a directionally based move, then we can get out of it and we have something to offset those losses. And so that's really, what we're going to get into. And I'll tell you this, next week when you and I start, we're going to start with just the credit spreads. Okay, we're going to go a couple of weeks, maybe 3, and then I'm going to talk about insurance, and we're going to go back and add the insurance pieces because I want to get good at, or get you all good at not only finding these trades, but also adjusting these trades as the markets move directionally, get you comfortable with that piece of it, and then we're going to bring in the insurance, but that is what it's going to look like about a month from now, where we're going to be. So, folks, next week, for those of you that are not registered, next week starts my annual Layered Credit Spreads Master Series online class. This is a 5-week program. It's actually going to be a 6-week program this year. There's a bonus class that we're going to do that's going to be included in this as well. So we've updated this for 2018, and we set the schedule so the timing is just absolutely perfect to get started next week. And with our 43 days right in there to option to March expiration, so we can start that perfect layer and start working into to March's cycle. So what we're going to talk about over the course of the next, let's just start with the 5 weeks, and then I'll talk about the 6th week class separately, is we're going to start with the basics of finding credit spreads. How do you find 92% probability trades? Next week, we're going to do this the old school way. We're going to take a look at using, I use Thinkorswim, so we're going to log into Thinkorswim, and you can do this on Options Express or Schwab, anywhere you get a basic option chain. You can do this on Tom's Tools with an option chain as well. We're going to do this the old school way, and then I'm going to show you how to do it on Tom's Tools as well. We're going to get into the basics of not only finding these trades, but how do you place an iron condor trade? There's really a right way and a wrong way to give yourself a higher probability of getting filled. Now, with an actual trade. Finding trades is one thing, looking at risk graphs is another thing, right? And taking that theory at that point, it's all theory until you actually get the actual trade sitting in your actual trading account. And so I'm going to share with you how to do that, doing this for many, many years. I will say as well that, I do not want you to place actual live trades throughout the course of the class. I want you to get through me guiding you step by step on exactly what to do. I want you to be placing the virtual trades, please, because what has happened in the past is occasionally students will place a live trade, the markets move directionally, and we haven't got to the delta adjustments yet, and student says, what do I do? And they can't focus on the material because they're worried about a loss on a trade, and I don't want you to be there. I want you to go through all the steps. Please get your virtual accounts tuned up, dialed in, and most of you, if you have a live account that's open right now, you can just log in on their virtual site and practice placing those orders. Week number 2, we're going to start talking about layering to reduce risk. We will open up a second layer if it is available. Okay, most of the time it is during that second week. And we're going to start working with individual credit spread adjustments, how to adjust these when the probability falls from 92 to 80%. We'll start working to what's called an all-in-one adjustment and adding insurance, adding the debit spread insurance. How does a credit spread layer pay for debit spread insurance? And when we have a probability that drops below 80%, how do we non-emotionally and in a non-panic manner execute and actually facilitate these trades? And so we're going to walk step by step through this process. And the cool thing is that we get to see these trades build and happen, essentially in real time, every single week, and see this layer start small and get larger. And, the cool thing for me is many of our students that have gone through this say, Devin, wow, this just seems so overwhelming. But I do it and I break this down in such small parts that for most of you, you get to week number 4 and you're doing 3 possibly trades in a week or at a time, maybe working on an adjustment with insurance, and you're like, holy smokes, I just did this. It's not that complicated, right? Because you're just doing little baby steps, taking small bites, working into that larger picture, that larger trade. So class does start next Wednesday. The classes will be at 8 o'clock p.m. Eastern Time, 5 o'clock p.m. Pacific Time. That will be the case for all of the classes. They will average approximately 2 hours apiece, some perhaps a little less, some perhaps most likely a tad longer. I don't stop the clock right at 2 hours and say, see you next week. If there's questions, we will go through and answer those. One of the greatest benefits of these classes is they are all recorded. This is really, really cool. Every screenshot, just like today's class is, and Tom's past classes, they're all recorded. You can go through, you can view these 100 times if you want. Make sure you get the information and make sure that you get all the content. A lot of times just going through it a second or third time, you start to understand it a little bit more because you hear it that second or third time, it starts to sink in. So that is available for you. Back in the old days, Tom and I used to teach this in an advanced class in Las Vegas. I mean, this is going way back. Quite honestly, it did not work out so well because I was teaching how to layer a market over the course of a day and a half. And I would talk a day and a half on this subject. And we didn't have the benefit of watching the markets grow for 5 weeks and making those adjustments as the markets moved and layering in additional trades in real time. So the advent of these online types of programs like we're doing right now is it's unbelievably cool. The retention rate from our students has gone up drastically. And this is the only way that I teach the comprehensive Credit Spread Master Series class is in baby bites over a period of at least 5 weeks. All right, so let's go ahead and jump forward here. Also included with this is the Credit Trapper Scan. I know some of you have this already, some of you don't. Some of you may have Tom's tools but not have access to that Credit Trapper button. You will have access to that as a special bonus with this program. You will also have access to me through the discussion boards, both during and after the class. Quite honestly, this is one of the reasons why I only do this once a year. I make sure that my calendar's clear. I have a lot of stuff going on right now in life with family, moving, doing a remodel on 2 houses, my own trading, and everything else as well. I give you 100% of what I have. You can ask questions on the discussion board, posting homework on the discussion board. I will give homework every single week, and I do go through and grade essentially or review, comment back on every single person's homework assignment that's on there to make sure that you are ready to rock and roll over the course of the next week. So that's included as well as live technical support provided from Jay, Tom, and their staff. So for the bonuses, I mentioned that we are going to turn this into a 6-week class. So this is a very interesting series where we're going to go through 5 weeks. And over the course of the last couple of years, during Tom's big year-end event. Last year was in Florida. The year before that, we were on a cruise ship. I've been talking about some non-credit spread stuff. I've been talking about some non-stock stuff, so to speak, and talking about things such as balance sheets and how do you truly become a professional trader slash investor. And one of the things that we're going to talk about in week number 6 is I'm going to put together what I call my money class. And I'll be honest with you, this is the first time I've taught this money class like I will be teaching it here on week number 6. And we're going to talk about how to become a professional investor and those balance sheets. And that's going to lead into another topic, which is how do you know when to trade what strategy? When should I have more of my money in directionally based trades? When should I have more of my money into credit spreads, the layering system, or when should I have more of my money into trading stock splits or moving average crossovers, or you name the strategy? And we're going to go through that by doing what I call knowing your numbers. But we're also going to talk about some stuff like creating a budget, kids and money. A couple of our students, a couple of you that are registered right now have asked me to talk about, hey, Devin, why do you like real estate rentals, for example? I'm going to take a few minutes and talk about that as well. So it's kind of an open money talk class as well as a comprehensive full review on the entire first 5 weeks. So this is one for sure you are not going to want to miss. Just knowing how to take your personal finances, whether you are doing this part-time, just getting started, been doing this for years, and truly turn trading, investing, bringing in your retirement accounts, looking at least at your retirement accounts to help you make decisions on what you should be trading. This is going to be a big, big class. This is a big bonus, and I'm really looking forward to talking about this. Bonus number 2 is a primer video. This is one I put together a couple of years ago with Tom. This is for the new credit spread traders. And I can't remember exactly what it was, an hour and a half-ish, in terms of time frame, hour and 45 minutes, where we go through and essentially prime you on the basics of credit spreads. More examples of what the construction of a spread is. How do you place a bull put spread order? Just some of the basics. We'll cover this in a little bit more detail starting next Wednesday. But I will ask this of you, because this will be emailed out as soon as you sign up. For those of you that are not yet registered, please, 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 if you've not traded a credit spread before, please watch this video once, maybe twice, before we jump into next week. And that will give you more of a stronger foundation that we can build upon getting into next Wednesday. Bonus number 3, 60 days of Tom's tools. This includes Money Calendar, Darknet, TradeStream. There's just a whole bundle of stuff here that this includes. And this is huge, folks. I mean, there's so much stuff in Tom's tools that is awesome for stuff outside of trading credit spreads. And just, I mentioned I like directionally based trades. I love credit spreads. We tie this into week number 6 of when to trade what and how to change dollar allocations, and that's solid. There's so many cool things on Tom's tools to show you how to use the money calendar, for example, to find, historically what has done the best on which calendar days, so when to make, when you can increase your probability and reduce your risk to make the most amount of money in the shortest period of time, right? That's why we're doing this. So this is really cool, and I'm glad that Tom has decided to include that for you all to kind of play around with here as well. And above and beyond that, Tom is including 30 additional live webinars. These are webinars that are taught, throughout the day, no set time, throughout the year. These are taught by Tom and his team. Topics include basic strategy, directionally based strategy, other non-directionally based trading systems, how to use Tom's trading tools, technical analysis. There's a whole array of different topics that this includes. And we also offer a money-back guarantee. And we'll talk about the price here in just a second. We offer, folks, you can go through the primer video. You can join me next week. For those of you that are not registered, or even those of you that are, you can attend next Wednesday's class on January the 31st. Go completely through that, watch the recording, and if you believe for any reason that this is not something that you want to continue forward with, we will give you a 100% full refund on this package. And I'll be very honest with you. The reason that we offer this guarantee is because we don't have a lot of students that take us up on it. I mean, quite frankly, most folks will go through this and say, hey, this is cool, I can do it. But if for any reason you decide this is not something that is right for you or right now for you after you see more of it and start doing it with me, then by all means, let's part ways as friends, and maybe some other time we'll work out. Okay. So when we originally put this together years ago, Tom and I have a long history of teaching classes. I mean, Tom and I go back to 2003 when we first started out together. And when I first put this together years ago with Tom, Tom asked me and said, "Hey, Devin, what do you think we should sell this for?" And I said, "Tom, I don't know, $10,000, $9,500, and he kind of chuckled. And I said, "No, I mean, serious. I put a lot of time and energy and back testing and my own money and own losses, and I have a time-tested system. It's worth that." So, Tom put together whatever Tom put together in terms of price, and our retail pricing right now on this is $3,693, which is an incredible deal. But for you all going through this program with Tom and continuing forward, he has put together, and I have nothing to do with this. This is Tom. He's put together what I call a stupid cheap price. It's just a no-brainer. It's $1,995 to join me for the entire 6 weeks, all of the bonuses, those 30 extra classes. That money class in and of itself is worth the $1,995. But for up to me, I would charge more. But thank Tom for this one. We really make this so everybody can do it. Come hang out with me and really get your arms around this and grasp this and carry forward with it, and and have a lot of fun with it and work with me. And this is going to be it for me for the year. So, and the reason that I'm doing this now and not in the summer is just the projects that I have that are coming up. So take advantage of this, and especially with the markets where we are right now. As Tom mentioned, I think we're going to see some volatility. I really do in the markets. Kind of going back to the Dow, what I think the markets are going to do. I think we're going to see some stronger downward days. I think we're going to see some stronger upward days, and some times of uncertainty, especially as we get into that time frame between May and July of this year, which will only increase the volatility and even make the system so we can create safer trades, should that occur. So anyway, I don't know what's going to happen with the markets, but regardless of which, I will show you how to open these high probability trades and make adjustments as the markets move directionally.
Dev?
Tom, do you have that link to send out to folks?
I most certainly did. I put it in the chat box. It is www.tomgentile.com/18 credit spreads. If you click on that, you will come to the page that I'm showing you right here on the screen. And at that page, you can see all the information that Devin had talked about. Down here where it says 25 spots available, if you click on that orange button, that's going to take you to our terms of service. Read through this. Once you agree to this and you click I agree, it'll then take you to our PayPal page. And now if you're a member of PayPal and you want to pay through your PayPal account, you just log in. If you want to use a debit or a credit card, down here below this login button, you'll see a gray button that says pay with debit or credit card. If you click on that, that'll take you to a form which you will simply fill out. And you'll also see, once you get through this, you'll see right here, $19.95. That is the special price that we're offering. And that does include all of the bonuses that Devin had talked about. And it really is, it's 6 webinars with Devin, but then it's also an additional 30 webinars you're going to be getting as a new credit spread trader, and obviously new to us, through some additional live webinars that we're going to be doing during the market hours. We actually do them every day from 2 p.m. to 4 p.m. In fact, I am going to be jumping onto that next webinar here in just a few minutes. But that's it, folks. Again, it's www.tomgentile.com/18 credit spreads. I put it on the chat window for you. You can find it and just click on that, and it'll take you straight to the page here. and then it's just a matter of going through the simple steps to get on. And Devin, you're already having people sign up. Devin's class, he typically does this at the beginning of every year. I'll tell you this too. It usually ends up selling out before we even get to the last day. So it's, once we have all of the spots claimed, you will see this dim out, and you're going to see a sold out sign on here, which happens quite frequently with the stuff. We keep the numbers small so that Devin can talk to you both live in class and through his forum as well, which we open up to his credit spread mastery students. Devin, any final words?
Well, Tom, I just want to mention that as well. That's one of the things that I've requested in doing this. One of my demands, if you will, is I love speaking to large groups of folks, but with this particular product, my goal is for you to understand and be able to carry forward. And the only way really to do that is to limit the number of students that we have in these workshops so that I can truly reach out and go through everyone's homework assignment. And if we had 500 people on the call, there's no way that I could do that. Right. So you will be getting a lot of personal attention, essentially whatever you want. So it is a smaller, more intimate type of a workshop, and I just want everybody to understand that. So come up or show up next week with your sleeves rolled up, and let's do some work and have a lot of fun together.
Absolutely. Well, thank you very much, Devin, and we'll see you next week. And folks, if you want to take advantage of this, again, TomGentile.com/18 credit spreads, limited time, limited amount of spots. Take advantage of the money back guarantee and see if this is for you. And Devin did chuckle when he says, most people do not take advantage of that. And I have to agree. I mean, the majority of people come in and realize the value of this and realize that they have time with someone who truly is a credit spread master. So thanks a lot, everybody. I'll have the recording to you as soon as we possibly can, and we'll hope to see from you really soon. Thanks again. Have a great day. Bye, everyone.